Good morning, everyone. Welcome to our Accessing Capital, How to Prepare for an SBA Loan webinar, sponsored by Orange County Government. My name is Teresa, and I will be your tech support and organizer for the webinar. Our Florida SBDC at UCF presenters today are Jairo Batista, our marketing manager and consultant, Maggie and Candela, our consultant, and Michael Oppenheim, also a consultant. The Florida SBDC Network was established in 1976 by the U.S. Small Business Administration to provide technical assistance to small businesses. The FSBDC is part of a nationwide network of small business development centers with nearly 1,000 local centers across 50 states and U.S. territories. We are funded in part by the U.S. SBA, the state of Florida, and local economic development organizations. We are state designated as Florida's principal provider of business assistance and nationally accredited. The state of Florida consists of 9 regions. The Central Florida Regional Headquarters is located in Orlando, Florida, and hosted by the University of Central Florida. We cover an 8-county region, which includes Orange, Seminole, Osceola, Lake, Sumter, Volusia, Brevard, and Flagler counties. Some of our local centers are also hosted by state colleges, including Seminole State College, Eastern Florida State College, and Daytona State College. Our primary services are no-cost expert, confidential, one-on-one consulting. And with connections to the Florida SBDC Network and UCF, our consultants have a large, extensive access to market research, which was no cost to you through our services. And just like the program today, we continue to support small business through many stages of growth. In addition to our training and our consultation services, we offer special programs for second stage businesses within our region. These programs are like our CEO Exchange, Advisory Board Council, and our award-winning Small Business Institute. And last but not least, we offer these business training seminars and webinars for all stages of businesses. And before we get started, I need to cover a few housekeeping things about how your experience with our webinar today will go. Your mics are muted by default. If you have any questions, please feel free to use the question chat box feature in your GoToWebinar panel. We ask that you make your questions as specific as possible so that we will be able to answer them appropriately when we get to the questions portion. Please do not use the raised hand feature. We can only take questions and comments through the question box. Copies of today's presentation can be found under the Handouts tab on your GoToWebinar panel. An evaluation survey link for this presentation will be emailed to you shortly after the program finishes. These surveys are very important to us, and they give us a lot of information about your interests and what programs we will continue to plan in the future. So if you can please take a few moments to fill out that evaluation when you receive it, we would greatly appreciate it. And without further ado, I'm going to pass it over to your presenters.
Good morning, everyone. My name is Maggie and Candela. I am a consultant with the SBDC for the last 5 years. 6 years ago, I retired from banking, so I was a credit officer in a bank that was a person who approved loans and also taught underwriters on how to approve loans, and I did that for 30 years. We're not going to cover the same information that we did last year in September 2021. That webinar that we had out there talked about the different types of SBA loans and did a deeper dive into their terms and their repayment, interest rates, etc. That webinar is still on our website and you can access that at any time. Today we're going to talk about certain things that you need to prepare for in order to get an SBA loan. So if you're on this call, you should have already made up your mind that you're either going to apply for a 7A loan or a 504 loan. We're not going to make a distinction between the two. As I said, you can look at that on that other webinar. We're going to talk about the SBA rules under the SOP, which are the same for both programs. Okay, so we'll touch on the eligibility rules. There is a credit elsewhere test that is part of the SBA lending program that was set aside during the disaster loans for COVID. It is back in play for the regular 7A and 504 loans. We're going to talk a little bit about getting ready and the financial health of the individuals that are the owners of the business, who will be guarantors of the business. Validating your business concept, doing that SWOT analysis, which is the strengths, weaknesses, opportunities, and threats, how that all comes together into your business plan, your budgeting, and your forecasting for the loan as you approach the bank looking for that financing, okay? We're not going to go into how to write your business plan. We have webinars for that. You're welcome to sign up at any time. Some of those are also on our website that you can view at your leisure. We also have programs on how to build your credit score and on business evaluations. If we're talking about business acquisitions, we may touch on that a little bit when we're talking through some of these scenarios, but we're not going to go to a deeper dive. We'd ask you to join those webinars. And also sign up for consulting services, and we'd be happy to talk to you about any of them. So the first thing I want to mention is the SBA eligibility rules. There is a form, it's SBA form 1919. If you go to sba.gov and you search for that form, you can find it, or you can ask any one of us and we can show it to you and send it to you. This form is basically, I refer to it as an eligibility checklist. There are 3 parts to the form. The first part of the form is the applicant. The applicant is always the business. The second part talks about the owners. And there's now a third part which deals with ownership that may be held in a separate LLC or a separate 401k or an IRA, something other than an individual. The purpose of this form is to make sure that any of those parties are eligible for financing under the SBA. So things that are really important to understand are, if you've had any previous federal loans, did you have a USDA loan, a BNI loan, an SBA loan, any of those types of loans, it will ask you that question. If you answer yes, it will ask you if there's any delinquency, or did you ever have a default? A default under a federal obligation will make you ineligible for an SBA loan until that situation is resolved. Oh, okay. That would include if you had, for example, an SBA loan in the past and you didn't pay it in full and you followed the SBA rules for what they call an offer and compromise, where you settled the loan for less than the full amount, that will make you ineligible for an SBA loan in the future. There are also other things that will make you ineligible. A bankruptcy in the past doesn't necessarily make you ineligible. You will have to write a letter of explanation about the situation regarding the bankruptcy, what creditors were not paid in full. Generally, and again, I'm giving you this from a banking background, generally, banks will look at bankruptcy where you were discharged from bankruptcy. If you did not pay all of your credit cards, that's one issue. If you did not pay a loan in full that was a secured creditor, that may be a separate issue and could prevent you from being able to get financing. If there's any revenue derived from gambling, marijuana that is not federally approved program, or anything of a prurient nature, anything not to be so graphic, but like an adult bookstore, things of that nature, those are not eligible for SBA loans. If you've had a criminal offense in the past, believe it or not, that is okay, depending on the situation. There is more work that has to be involved. There is fingerprinting. They have to get behind the nature of the issue, and then they will make a determination. They being the SBA, the bank doesn't make that determination. They send that information to the SBA, and the SBA makes a determination if you're eligible. It could be that it was a minor offense, but the question actually is, Other than a minor vehicle violation, have you ever been convicted, pleaded guilty, pleaded nolo contender, been placed on pretrial diversion, or been placed on any form of parole? And another thing that will create an issue is if at least 51% of the owners of the business are not U.S. citizens or lawful permanent residents. You can have people that are owners of the business that don't meet those two qualifications, but they have to be less than 51% of the ownership. Okay. The no credit elsewhere test is really the best way to explain it is if you are able to get financing on acceptable terms and your business can support financing under conventional loan terms, then the SBA program may or may not be acceptable for you under the SBA rules. But let me take a step back from that. The purpose for the SBA is to ensure all small businesses have access to capital. Small businesses are based on size standards, so depending on the industry, it could be if it's, for example, a wholesale industry, if you have more than 100 employees, it could be also based on the size of the transactions for the loans. SBA guarantees max out at 75% of the loan amount. And the most you can get under a 7A loan is the $5 million with the 75% guarantee. Once you're able to gain capital, access to capital in the 6 million and higher brackets, then you're not deemed a small business anymore. Your revenue size, your balance sheet size would put you above a small business definition. So when I say it, we'll back up a minute, because when we talk about no credit elsewhere, as this outlines, the liquidity of the owners can be an issue if you have a lot of personal liquidity, more so than the loan amount. Say you only want to borrow $100,000 and you have $150,000 in savings, that would mean that you have access to fund yourself, or maybe even with a conventional loan and don't need the SBA. But a lot of times the SBA can still be a source, and a lender may give you options for a conventional loan and an SBA loan if your growth plan that you present with your forecast would suggest that you need that longer repayment term in order to continue to build equity in your business to finance future growth. Or if for some reason what is needing to be financed, if it's a working capital loan and we're financing the hiring of people, or we're financing receivables and inventory, cash flow gaps, that is not, even though they would take those assets as collateral, not the people, but the inventory and the receivables, that's going to be taken as collateral for your loan, and you will have an equity portion of the budget. I don't want to get this too confusing for everybody, but banks don't look at liquidation of those assets based on your equity contribution. So let me give you an example. If I'm making you a working capital loan and my collateral is going to be receivables and inventory, and I tell you you have to put in 20% equity to the budget, that would say I'm lending you at 80%. Well, when a bank makes an assessment of collateral, acceptability of collateral, they're going to discount receivables and inventory by about 75%, because if they had to liquidate it, they would not get more than 25 cents on the dollar. So that alone can make you eligible for an SBA loan. That difference in true equity and liquidation value. Keep going. So when we talk about another part of the credit elsewhere test is this debt refinance or the consolidation rules. A lot of times people will come to us and they'll have a lot of credit card debt, personal credit cards that they may have used, that they use for the business, or other credit facilities that they've had to use over time and didn't really approach their financing and their capital goals maybe early on proactively enough to have a loan that can support the growth plan. Those loans can be rolled up, they can be refinanced, but there's rules again associated with that. There's another form, Form 2202, Schedule of Liabilities, that you'll have to submit, which will show all of the loan terms, the original balance, and what the repayment terms are. The reason you're asked to submit that is because if the bank with an SBA guaranteed loan is going to refinance those, they have to make sure that the terms of those loans are not reasonable. And a good example of that is if you have a real estate loan that you received from a bank and it had a 10-year term but a 20-year amortization. The fact that it has a balloon can make it unreasonable because an SBA loan is a fully amortizing loan. The term of the loan, the maturity of 20 years or 25 years matches the amortization. So if your loans don't, they may be eligible. If you have credit cards and they have higher rates, the tricky thing about credit cards is they have to be 100% used in the business to make sure that they're eligible. So it's all going to depend on your record keeping. Those higher interest rates make them eligible for a refinance. Basically, the bank has to be able to prove that there is a cash flow savings of at least 10% by combining those debts and refinancing it in order for those to become eligible. So that's a test I'm sharing with you. We can also send you the form. That's something you can do on the front end to see what you can and cannot do to consolidate your debts. So one of the things that when the next thing we're going to talk about is, so you made it through the eligibility form. That looks pretty good. You've gone through your schedule of liabilities. You think that you're going to be able to do the refinance if that's what you want to do, if that's applicable to your situation. Before you go to get an SBA loan, you have to take kind of a moment and evaluate your own financial health as individuals and owners of the business. I cannot stress this enough. Oftentimes we have clients that we'll be working with to get their application put together for a bank. We're talking to the banks on their behalf, and at the 11th hour we find out their credit score isn't as good as maybe they portrayed it to be at the front end. Credit scores on your personal scores matter, and they matter more the smaller the loan. And the reason for that is most small loans up to $250,000, if you're applying at either a large national bank or a regional bank, a lot of those loans are what we call credit scored. If they're in a large national bank, they have their own proprietary models. There's also models that are off the shelf that some of the more regional banks or even community banks will use. And the biggest components of those score models are credit score, time in business, industry, and cash, more so than cash flow. They do look at cash flow, but they look at your liquidity. What is your business liquidity? Okay. So they'll look at that, and they'll also look on a combined basis. So if you don't leave all the money in your business and you take it out and you have it personally and you have good personal liquidity, you'll get added points for that. But those loans generally are scored. A good credit score for a bank, irrespective of type of bank, is 700 and higher. A lot of banks in the Central Florida area will look at credit scores of 680. If your score is lower and it's in the 650 area, that would still make you eligible for an SBA loan, but unfortunately, the SBA doesn't make these loans direct. The banks make these loans, and the loan is guaranteed by the SBA. The banks cannot be less stringent than the SBA SOP, but they're allowed to be more stringent. And so they're allowed to have a credit score that is higher. In an economy such that we have today, when we have inflation, banks are going to push harder on not making any exceptions to those rules on credit score, because in a economy that is struggling, a credit score is more likely to go down than it is to go up. If you think of your credit score is a point in time, okay? As of today, when my credit was pulled, this is my score. Your score may not be, it may be lower in 30 days, it could be higher in 30 days. The things to keep on top of your mind are to try to keep all your creditors current, keep your revolving debt burden below 30%. And if you pay off something because you're trying to get your credit score improved, don't necessarily close that credit line, because a credit score is also based on the breadth and depth of a score, meaning more trade lines with positive history, the better the score, okay? The other thing to know about credit scores is it's only reviewed on owners that own more than 20% of the business, okay? Another point is insufficient equity for the business or cash reserves. We talked about that. That's part of the assessment. So we'll talk about that later when we're talking about building the budget. But when it comes to you as a person, either you have the money in your balance sheet or you have it in the business. They will also look at what is your need on a personal level for that same level of cash that you're keeping on your personal balance sheet. How much debt do you have? Do you have a leveraged financial statement yourself? Do you have a lot of cars financed, houses, boats, planes, whatever the case may be? Okay. I have heard people talk about, well, I'm going to use my home equity for my liquidity for the loan. The thing to know about home equity, if you have a home equity line of credit and you've already borrowed the money, you would be able to use that as equity. What a bank isn't going to allow you to tap into your home equity today and make you a loan today and call that equity, because it's still borrowed, okay? An old bank, again, old banker rule of thumb, the way banks look at home equity, if it's truly earned home equity, you bought your house at a 50% loan to value, meaning you only borrowed 50% of the purchase price. Or maybe you bought it at 80%, but you've lived in the house a long time and you paid down that mortgage. And so your original equity to your original home value is there. Banks look at that differently than equity that has been achieved based on market increases. So if you're planning to use your home equity because you're going to expand your business or you're going to start a business and you want to use that as your equity portion, banks look at cash equity going into a business based on 2 statement cycles from your account, meaning 2 full statement cycles in your checking account, savings account. If the money is there at least 3 statement cycles back, it's usually not questioned as to the source of that funding. But beyond that, don't be surprised if they would make your loan ineligible even though you have that equity. The next thing we have to talk about is the financial health of your business. And this, again, is before you apply for a loan. A big key is insufficient financial records. If you don't have QuickBooks, and I'm not saying everybody has to have QuickBooks, but if you don't have QuickBooks, you have to at least have an Excel financial statement that supports all the money coming in and going out of the business. Hopefully you've set up your business to where you're operating out of one account, one checking account where the money's coming in for any of the sales that you have for your goods or services, and all of your expenses are flowing out of that. If that's all you have other than tax returns, that won't preclude you from applying for a loan, but we do have to get that information in a format that the bank will accept. They will accept an Excel spreadsheet, and we can help you with that. We already talked about some of these other things. The one thing I will point out is this mishandling of a business bank account. It's just as important as to have good credit on the personal side as it is to make sure that you don't have a bunch of overdrafts or NSFs, because when you apply to your bank, that is the first thing they look for. We call those red flags. How did you handle your deposit account before you had any loans? And they will look at that, and that can preclude you from getting a loan. And the other last thing I will point out is make sure you establish, if you're just starting out and you don't think you need to borrow anything, establish business credit early. At least get a business credit card, even if you don't use it, except for maybe once a month. Pay something with it. Pay your electric bill, and then pay your credit card. That just gets you in the habit of establishing credit. It will help you in the long run as you go to apply for other loans. Okay, so as we move through the process, so now we've done that. We've taken an assessment of ourselves. We've taken an assessment of what we need for the business, and we're trying to get our package put together. One of the things that we will help you do is we will take your financials, and we will go through and we'll do a financial assessment of your business to see where you may or may not align with what your budget plans are for the business, for the loan, to see if you're going to be able to qualify. We look at that. We compare you to the industry. We try to help you look for places where you can have some savings, maybe adjust some of the things that you're doing in your business to overall improve your financial health. And that's part of our initial assessment to help you move through. The information that we need is on the next slide. It's the same information you're going to have to prepare for any loan that you try to apply for at the bank. Okay, so we've gone through all of that section. We talked about the SWOT analysis, and so Michael's going to talk a little bit about that. And a lot of you on this call may know what that is, but it's really important because when you think of how an underwriter looks at lending and looks at making loan decisions, this is kind of the assessment that they go through when they're looking at your loan in relation to any other loan they could make that day. What are the loan strengths, weaknesses, opportunities, and threats?
Right, thanks, Maggie. As Maggie pointed out, it's a multifaceted approach to what banks look at. So not only is the credit side that Maggie just reviewed extremely important, but it's also what is the industry like? What is the experience of the people running the business, and what is a competitive outlook in that particular industry? So the areas identified above are the minimal areas that need to be addressed in your business plan, and quite frankly, for your own benefit. The greatest concept cannot be executed without the right people, products, and profit. You should be able to objectively assess each area and create mitigating strategies for all the weaknesses as well as any perceived threats that may come to fruition. Likewise, you need to ensure that you have the right capital to take a competitive advantage when opportunities come your way. Each assessment needs to have the overall theme of 1, what is the cost to execute my strategy? And 2, what are the benefits? A third layer of assessment is whether the identified benefits exceed those of alternative strategies, known as the opportunity cost. And just so you know, any of the SBDC consultants can assist you in developing and evaluating your SWOT analysis. Industry research to go along with the SWOT analysis is extremely important. Banks want to understand how competitive of an industry is it. Are you opening another hamburger stand and then right in between a McDonald's and a Burger King? So they want to understand and take a look at marketing plans in full competition. We, as Maggie stated in the beginning, as well as Teresa, the SBDC has multiple tools to help evaluate and assist you with developing your marketing plans, from a social media perspective to industry related data such as IBIS reports, and we can get a full demographic detail for the target market. We can pull competition, we can get a clear understanding of all the competitors in your area through Reference USA, and quite frankly also Reference USA also provides a great list for potential prospects down the road. And BizMiner and ProfitSense helps undertake the financial side of saying, if we do this, does this make sense? As a result, the revenue assumptions and forecasts must be supported by quantified metrics that can be tested in the marketplace. For example, you may be buying a 4-bay auto mechanic shop that is only using 2 bays. You may have plans to hire more mechanics and be at 100% of your utilization. You would quantify the potential revenue earned in these 2 bays operating versus the cost of the additional team members, the additional labor that will become fixed cost, and then variable labor such as higher utilities to determine if the upside can more than pay for the incremental debt associated with the expansion. Part of that assessment is determining if the target market, your location that you're choosing, supports the need for the extra bays or do you need to take the business from the competition?
And you can access Reference USA at your local library, but from what we understand from the vendor is that at the library, the access that you'll get for information is more limited than what we can provide to you, and ours is provided at no cost.
What we're going to do now is walk you through examples, because we find that when you provide examples, it's a better teaching tool, and we've chosen 2 distinct scenarios. One is a mechanic shop.
Pest control.
Oh, the pest control, that's right, I'm sorry. And one is a restaurant. But you can see with mechanic shops and manufacturers, different variables that need to be considered as we go through it. So when you're completing a competitive assessment for a bank loan submission, the idea is to identify how your business compares to alternatives in your target market. It could be that you're planning on locating your business in an underserved market for what you're offering. The assessment needs to be more detailed the more reliant you are in taking the business from your competition.
So I like to maybe for my own benefit, kind of dumb things down to kind of common sense things. So when you think about this, and I say that, dumb things down to how the bank thinks about it. Not that you guys are that way, but so that you can get into their head. A bank is going to look at you and say, this is how much money you made in the past, and now you want to take on debt. So they want to understand the assumptions you're using, that you will make more money to not only repay the debt, but also create a return to yourself, right? Because most people aren't going to say, well, let me take on a $200,000 loan and basically make less money because now I have to pay debt, right? You're going to want to have that additional income. So that's what the bank is going to look for, as basic as that can be explained. Okay, so in building the loan budget, so some of the loan budget considerations that need to be spelled out in your business plan, and I will say need to be spelled out because they're going to look for them, especially in the market that we're experiencing now. Michael's touched on a lot of them, but one that I would want to touch on specifically are staffing requirements to scale your business. because that is a hot button for everybody, because it is very hard to attract and retain employees. So what's your plan on that? There is a lot of automation going on, even in the restaurant industry, where they now have robots that can deliver food to tables. But if you're not there and that's not part of your loan request, then you're going to have to address how you're going to have the staffing to meet the either production or the service requirements that you have to generate that revenue that you have in your forecast. And again, that return on investment, whether it's to you as the owner or to an investor, if you're going to use investor money, that needs to be spelled out. We're not going to talk a lot about this, but the next slide just talks about the equity injection that's required. Again, this is the amount that they would expect for you to come up with as part of your budget. If you're an existing business and you have assets that you own free and clear, oftentimes you can only have to put in 10% as opposed to that 20 or 25% for example, for inventory or machinery and equipment. You will never, and I spell this out because a lot of times last year people were thinking they could get 100% real estate financing. It just can't happen, and it doesn't have to do with the SBA specifically. There are other banking rules that require all equity, all real estate transactions to have 10% equity. Okay, so our first example is a pest control company that wants to expand services to include irrigation systems. They already have general household, they already have lawn and ornamental. They've elected not to have termite because that's additional work and certifications, and they send that work out. But they've decided to what we call vertically integrate to make their customers more sticky by having more client services for them, by also having irrigation. So that's sprinkler system monitoring, replacement, and repair. In this hypothetical example, and it's truly hypothetical, they've come up with an example that maybe historically they've had a lot of repairs on one of their trucks, so they're going to replace their truck as part of it. They need a new service truck for the irrigation guy. They need to pay him a base salary of at least $36,000 that they would like to cover commission they can get from maybe complete installation sales that he has. There's some core inventory that they're going to have to build. They want to be able to market. Initially, they want to market just to their current customer base, maybe if you think of it like a soft opening. And then they want to actually go out and do a push where they're going to do a marketing campaign. They're going to change their website and be able to really push the irrigation to make it become its own profit center. There's two reasons to do this, right? Make it its own profit center, ultimately the goal, but another reason for doing it is to decrease attrition, decrease the loss of accounts that are being solicited from those companies that do have both services, okay? So here's our budget. It's $220,000 for that example. And then we're going to talk about the restaurant example, and then we'll build the forecast.
And in this example, again, hypothetical, you have a business owner who owns, let's say in a strip center, a 12-seat restaurant. Whoever is in a retail shop next door decides to move out, and they're thinking about expanding, going from 12 to 30 seats, which is 2.5 times capacity. While they'll get some economies of scale, there are also areas that need to be funded by the owner, such as additional signage, certainly staffing with new wait staff, working capital, and the big item would be additional kitchen equipment, because you need to put out more food at a more rapid pace. Also would be additional chairs as well as tables to suit it. So our total budget is close to $160,000. We'll go back now and take a look at the pest control forecast, and then we'll go back and discuss the restaurant to show you how it would look on a P&L and how it would look on a projection which the bank is going to require, because the bank wants to know, if I lend you this money, maybe not in the very beginning, but will this be a profitable business going forward via these expansion opportunities?
Okay, so common forecast variables on the next slide. You guys can read that at your leisure. The next slide after that is the actual, it's a snapshot of the forecast for this pest control service company. Some of the elements that we put in for the forecast are listed on the left. And then you can see the first 6 months. The previous fiscal year end, again, assumes this is a company that exists. I promise you, this is a fictitious company. It does not resemble any one company. So that previous fiscal year end is a hypothetical. And then it's showing you what's going to happen with the revenues and the expenses based on the assumptions that we put into the forecast. So, for example, the revenue for general pest services, they charge $40 monthly. I understand that there's other ways that pest control companies charge. They charge quarterly, they charge semi-annually, annually. We tried to make this as simple as possible. If we were doing this for you, we would layer all of the elements of your business, products, services, and the frequency of which you charge for those products and services. Here's their desired growth rate is 6%. That's year over year. They have 5 technicians. This is obviously assuming that they have good geographic dispersion of their client base, because if they didn't, those technicians wouldn't be able to be as efficient as they are. You cannot see that in this slide, but in the Excel spreadsheet where we built this, there is a whole table on technician efficiency and how that feeds into the forecast. Same thing for lawn and garden, kept it simple, put it on a monthly basis. Understand sometimes that's bi-monthly, but we had to make it simple for this presentation. And now we're talking about what they're really trying to do. They're trying to, and that has a growth rate of 12%. There's fewer clients in the lawn side than there is in general pest. They're not all cross-sold between each other, and that's why you can have a higher year-over-year growth rate. And then in the irrigation, we made an assumption that this client, this hypothetical client, wouldn't have decided to go this route unless he knew a good portion of his lawn and garden and ornamental clients would want to have this service or are already using this service with another party. So we made an assumption that they've done a kind of a focal group, and they know that at least 96 of their clients are going to want to switch over to them, and they're going to switch over in the first 3 months of the quarter after they get the loan. And so as you can see, we have irrigation in there, and you're going to say, hey, at irrigation, the revenue versus the expense in cost of goods sold, it's upside down, and that's okay. When we build forecasts, we build them at least for 24 months. I will tell you, a bank, is it okay if whatever you're trying to accomplish, if you're an existing business and you're doing something new, if it's not 100% accretable, meaning it doesn't, in that first 12 months, if it doesn't contribute to the bottom line and it's just break even by the 12th month, that's okay. That's why we do that 24-month forecast, because by month 12, it should be break even. By month 18, it should be cash flow positive at the rate that the underwriters would want to see, and quite frankly, that you would want to see, because you're not going to want to invest in something that isn't going to bring you a bigger bottom line return. If we were able, and we can, if any of you on this call requested, I will send you the forecast, the hypothetical where we built it out, and you can see where it turns and it starts making money. So that's the first 6 months. Here's the second 6 months of the year. And again, it does start to go positive on a gross profit per rate there. I should point out the tech salary is in cost of goods sold because he's only providing an expense. He only is an expense because there is work. Otherwise, if it wasn't going to work out, you would eliminate that tech and you would not have that expense on a go-forward basis. You probably also saw the truck maintenance and fuel went down because we were able to buy that truck, and it doesn't cost us as much for repairs. Our advertising budget went down because we're focusing right now on cross-selling. We were grow before, and now we're cross-selling our existing customer base, and we're not having to spend as much, but we're keeping that advertising up so people don't forget about us. And then we're gonna, now that we've gone through the soft opening of our irrigation, we worked out all the kinks, we know we have everything down and we can deliver on our customer base and not lose customers because of our new service. Now we're gonna start advertising. We took the money in ahead of time, but we're not gonna start advertising probably until that 11th or 12th month. We'll start working on the website and spending that money in order to get ready to do the full court press for next year. So this is just a change in cash. We really don't have to talk about this other than you'll see when you, again, I can send you this spreadsheet. You'll see the money go in, the money go out from the loan funding coming in, and then money going out for your equity contribution. The point to bring up is just because when you do your budget, you're gonna have to put money in for equity if you're doing that from your business. It's okay to ask for working capital back. It's okay to ask for working capital back. You cannot ask for 100% working capital. You have to be directional when you're asking for working capital, when you're putting equity in from the business and you're gonna take as much back out in a working capital loan. Specify what you're going to use it for. You're going to use it for advertising. You're going to use it for that tech salary. You're going to have a cash reserve because if your marketing plan works as well as you think it is, in year 2, you may need that working capital as you add a second tech ahead of the business coming in to support that second tech. So you want to, when you apply for a loan, not just think about your need for today, think about your need for that full 24, 36 month period, because you don't want to go back to the bank before you've achieved what you thought you could do in your forecast, unless you just blow it out of the water, and then you might need to.
The next example is going to be for the restaurant that we talked about earlier. And I just want to take a step back. The purpose of showing you these 2 examples is to simplify the process, but I do want to let you know that if this appears to be overwhelming, again, your SBDC consultant will assist you through this forecast and budget process. So the key takeaways in kind of the current state are listed on the left-hand side of the page with the number of seats, the occupancy, the average ticket, and the hours of operations, as well as the staffing. For this example, it's assumed that you applied for the loan at the end of the previous year and it was approved by the end of March, and you'll be making your first loan payment in May. I'm going to switch now to the second 7 months, and you can see here on the left side of the page the big differences. Now you went from 12 to 30 seats. Your takeout has been reduced from 30% to 20% because there's more room inside the store, so you have increased sales there. And your number of employees, your back of the staff house went from 2 full-time and 1 part-time to 3 full-time and 3 part-time. In the front of the house used to be 1 full-time and a manager, now it's 2 full-time and a manager. We've kept the average food cost per person as flat as the same. And you can see how this loan works, because if you look to the sales, because we had a slow ramp up, I'm going to go backwards real quick and show that you can see in month 1 under sales, it's 26,000 to 23 to 27, and it remained that way for the first 6 months. because the loan wasn't approved till March, you can see we start a gradual ramp up. And by the way, the banks want to see this. The banks don't want to see pie in the sky and think you're going to go from 1 month doing 28,000 in sales and magically the next month all the way to 52,000 in sales, which we have projected out in the month of in the 12th month. So when you look at this, if you would project out this, and I'm gonna round down just for simplification, if you're doing $50,000 in revenue at the end in months 11 and 12, this basically turns this business into a $600,000 business by the end of year 2 if you extrapolate everything out. And no difference is you'll see like in the rent cost. The rent cost will start to go up, and where the rent used to be $28,000, it's now going to be by year at the end of year 2 approximately $60,000 in rent. So this loan makes a lot of sense, and under this scenario the cash flow will support the loan, and you're turning a business. And I'm going to go back again. You're turning a business, if you look to that previous year, a $286,000 business, and you're going to turn it into, by the time, we only did a 1-year projection again, but by the end of the second year, you're going to, this is going to be a $600,000 business. So you can see why in this particular example, banks will most likely in this scenario, given all the pre-qualifiers that Maggie laid out in the beginning of the presentation, that this would be a loan that they could be excited about. Again, the cash flow, I'm not going to spend a lot of time on there. It's no different than what Maggie described in the previous example, but you can see how after the first 6 months they are not profitable yet, but by the end of the entire year they are profitable. So now we're going to take a look at managing and obtaining the different ways to obtain capital. And there's quite a number of ways that you can go ahead and get capital through startup loans, through acquisition loans, existing business loans, and startup loans, clearly they have higher risk because the business has no track record. Acquisition loans, while they're higher at risk, I would make an argument they're less risk than certainly a startup loan. And then certainly there's existing business loans, and growth could deplete working capital or constrict cash flow. So there's a lot of different scenarios under how to obtain capital.
The thing I would just like to point out is the next slide is when and how to borrow. If you are borrowing money for what we call gap financing, timing differences between when you have to pay vendors and when you get paid, that can be supported by a line of credit. There are different types of line of credit. Some have open-ended maturities, some have fixed maturities, some are demand notes. We don't have a lot of time to talk about the pros and cons of those different types of facilities. If you would like to talk about any of those more, please sign up to be one of our clients, and I'm happy to have, or Michael, we could have a discussion with you about the pros and cons of those different types of lines of credit. If you're borrowing for a longer term purpose, like the examples we provided, even including staffing, because you're going to have to pay that person today, and maybe the full benefit of what they're doing doesn't pay off for 12 months or 24 months. That's a longer term financing purpose. That's when you use a loan. Loans are for when it takes longer to repay the expense than that next operating cycle. Lines of credit are for the gap financing, timing differences. There are non-bank lenders that you can use. You can also look to equipment leasing. If for some reason you can't get everything done through an SBA loan, you can talk to your vendors. A lot of them will provide equipment leasing. There are non-bank lenders. Cabbage.com is one that comes to mind. Some of these are very good. Some of them are not good. Stay away from the people that will quote you a payment and want the daily payment, the weekly payment, those loans are typically anywhere from 28 to 40% interest rate loans. They will call what we call in banking. If you start getting into those, you get into what we call a death spiral, because the cost of financing is so expensive, your margins cannot support that level of financing.
And I'm a big fan of the equipment leasing side, because that old axiom that cash is king. So let's just go back to even the restaurant example. If you need new kitchen equipment, instead of laying out $80,000 in cash today, maybe there's lease to own programs. I kind of call it industry or in-house financing. You don't have to go through the elongated process if you're just looking for more equipment in those type of scenarios.
Well, and it's really important for those scenarios where the useful life of the equipment, because of changes in technology, because of changes in consumer demand, if what you're acquiring isn't going to be useful for that full 10-year period, then you may want to try to lease that equipment before you invest in something that will not have a resale value when you have to go turn around and reinvest later for those upgrades. One thing that we just wanted to point out, that sometimes people, and this is on that eligibility form when I talked about there's a section 3 and you can use your IRA or you can use your 401k to invest in a business. This is the process for which you can do that. You see in red, that is my recommendation to you. Please proceed with caution. When you are using an IRA or your 401k, your life savings, and you're doing something that is not recession proof, it could be you lose your business and you lose your savings. And I would hate for you to do that. Always talk to a CPA before you're going to make that plan, and really think about what your concept is and how recession proof it is before you make that call.
With external investors, we'll stick to the left side of the page. From a friends and family perspective, before we even get started, I would tell you a formalized agreement and document should be established between friends and family, just to avoid any future conflict. It's extremely important not just to accept this friends and family loan without having some formal document that both of you can agree to.
Well, and if it is a loan, you're going to have a promissory note,
Exactly.
because the bank will ask you for that. So you will have to have a note. If it is a gift, they have to sign a gift letter saying they don't expect anything in return. And if it's equity, you would actually make them a part owner. And so they will get part of your income. It's not just on paper. If they are a 5% owner and you make $100,000 that year, they're getting $5,000.
They're going to get their distribution. And on angel investors, the big thing here, a couple of things, is generally they'll probably loan at a higher interest rate. They have higher minimum loan amounts to get involved, and it's going to be much shorter payback period than a traditional SBA loan. So therefore, your monthly payback is going to be higher, and we need to assess if that could fit into your P&L.
Okay, so I'm gonna talk a little bit about grants. To keep it briefly, the biggest strategy when it comes to grants is researching. So I provided a few links here that can help you out to start out. On the left side, there's more government grant sources. On the right side, there are more private organizations. The right side may have some sources that will require you to pay subscription for those, but the left side is all free resources. The thing about grants is a grant is tied to an objective that the grantor may have. So if it's a government grant, they may have an objective of trying to reduce homelessness, find new technologies, find new vaccines, things like that. On the private side, it could be supporting the restaurant industry. It could be supporting women-owned businesses, things like that. So just keep in mind that every grant has an objective every grantor has an objective they're trying to accomplish. Are there grants for starting up businesses? Not really. For the most part, you have to be in business already. There might be some local assistance programs available through the city or county. You may have to investigate that on your own, because all counties and cities have their own different rules. That's good.
Okay, and the remaining slides are in there for information purposes only. We talked about them in our last webinar, the underwriting definitions and how those play out. They're just there again so that you have them with this slide deck and you can look at them as you're going through the assessment of the financial health of your business.
Okay. Any questions?
Teresa, we have one question. To apply for a credit card for a business, should we have registered in IRS?
Oh, so if you're going to have your business, if you're talking about do you need your tax ID number, you should register in the state of Florida first. You should always get your EIN number, and then then apply for your business credit card.
And a great place to go is to perhaps the bank who lended you the money in the first place. They might want to assist you in obtaining that credit card.
Someone received a letter from national funding. Is it real?
From national funding, I would err on the side of caution and say no.
Unsolicited, well, sometimes if you are a business, there are people that are out there now soliciting people for loans, especially if they see you. I know some of the truck drivers are getting solicited pretty hard for these quick loans. Again, proceed with caution, because just because they are doesn't mean this one is legit, right? You have to follow your cybersecurity rules, right, Jairo?
Yeah.
But it could be that you're getting a solicitation. I always say with all loans, unless you're actively seeking it out, kind of be cautious of any solicitations that come your way, because they're usually at those higher interest rates.
A thank you from the audience member for answering that question.
Just a quick thing I wanted to mention. The Excel spreadsheets for the projections, they're on the handout section of the GoToWebinar platform, so you can download those at any time. Well, and we'll also email it to you afterwards as well, just in case you didn't get them.
Awesome. It looks like that's all the questions we have right now. Again, I'd like to point out that we will be sending in survey very shortly, within the next hour, to everyone on this webinar. If you can, please take less than 2 minutes to fill it out. We would greatly appreciate it. And I don't see any other questions coming in. Is there anything else you guys would like to say before we wrap it up?
Yeah, feel free to contact us. You see the contact information here if you have any questions. Again, please fill out that evaluation form. And if you're new to the SBDC, please go to our website at www.sbdcorlando.com and fill out a request for consulting form. We'd be glad to assist you going forth.
Okay, then. Thank you, everybody.